today my group and I would like to present about the realization concept. So before we begin our presentation, let me introduce my team members. First, we have myself, Zafran Mukris. The second is Muhammad Hakimi. And lastly, we have Muhammad Akil. Together we are from Group 5 and we are looking forward to sharing our presentation with you all. So before we start our presentation, here is quick overview of the agenda for our presentation. So first part is definition. I will start by defining the realization concept, and then the second agenda is the explanation. Hakimi will explain how it works in accounting, and then Akil will give a simple example to help illustrate the concept. And lastly, we have Akil who will conclude the presentation. Move on to the definition of the realization concept. The realization concept means that a business must recognize revenue only after it has completed the sale, when the goods or service have been delivered and it is clear that the customer is able and willing to pay. This means that revenue is not recorded when the order received or when the payment is made in advance, but it's only recorded when the business has done its part, such as delivering the product or completing the service. So what I'm trying to say that the realization concept focus on when the business can record the revenue. It's not about when the customer pay, but when the business actually earn the revenue.
I'm going to explain about realization. So first point is, according to this principle, revenue should be recognized when it is earned, not necessarily when cash is received. In most cases, revenue is realized when goods are delivered or services are rendered. The ownership and risk has been transferred to buyer. The amount of revenue can be measured reliably. It is probable that economic benefits, cash or receivables, will flow to the sellers.
Hi, now it's my turn to give you guys a simple example for you guys understand more easier. For example, at the beginning of 2024, Company Z received an order worth Rm15,000 to supply goods to a customer. That means they just received an order from a customer and not delivered to them in that time. During the year, Company Z delivered the goods worth Rm8,000, not the 15,000. The customer paid Rm5,000 for the goods delivered, and it's not a full payment. Company Z should record its revenue when it is realized. So the revenue to be recorded is Rm8,000, because the revenue record when company delivered goods to a customer, and the value to be recorded is the value of the goods delivered by company, even though how much of payment received from the customer, such as full payment or half payment. Now it's important to remember that receive an order from a customer is not the one that revenue recorded made. In conclusion, today we learn about the realization concept in accounting helps business record revenue at the right time or when it is earned and not before. This builds consistency, transparency and trust in financial reporting. Now that's all from us, and if you guys have a question to ask, you can just type in the comment below.